All right, today we're breaking down a really interesting quarter from Simmons First National. And I mean, really interesting. Their Q3 earnings report, well, it wasn't just about the numbers. It was about them hitting a giant reset button on the entire bank. So let's dive right in.
So let's start with the headline number, the one that made everyone's jaw hit the floor. A $4 per share loss on a GAAP basis. Now, when you see a number like that pop up from a regional bank, you can't help but ask one very important question.
Is this a disaster? A sign that the bank is in deep, deep trouble? Or was this a deliberate demolition, a calculated move to tear down the old structure so they could build something much, much stronger for the future? That's the big puzzle we're going to piece together today. All right, so let's get into the numbers. We've got to peel back that big, ugly headline loss. Because believe me, this quarter is telling two very, very different stories at the same time. And this really lays it all out, doesn't it? The tale of two quarters. On the left, you've got the ugly stuff, that big GAAP loss we talked about, and yeah, they technically missed on adjusted earnings and revenue, but only by a little. But then you look to the right, and that's the core story, and wow. Adjusted revenue up a massive 33% from last year. Net interest income, that's a bank's bread and butter, up 18%. It's like night and day. So here's the official scorecard against what Wall Street was expecting. Yep, a slight miss on those adjusted numbers. But again, the real story, the thing that matters for the future, is that incredible growth in net interest income. So the question is, where did that come from? It came from this. Just look at that chart. This is their net interest margin, or NIM. Basically, it's the core profit engine for a bank. And you can see this beautiful turnaround. It's been climbing, but then, boom, a massive jump this quarter. And let me tell you, that did not happen by accident. This was all part of a very bold, very deliberate new playbook. Okay, so let's talk about that new playbook. This is the so what behind the numbers. Why on earth would they take such a huge loss just to get that core strength? Well, it all boiled down to a 4-step plan to completely reboot their balance sheet. So here's the plan, step by step. Think of it like a major renovation. First, they raised some cash, about $327 million. Then, and this is the painful part where that big loss came from, they sold off a whole bunch of old, low-yielding investments. Step 3, they took all that cash and paid off their expensive debt, kind of like paying off your high-interest credit cards. And the final result? A much cleaner, stronger balance sheet that's now what we call asset-sensitive. In simple terms, that just means they're set up to make more money as interest rates go up. And this quote from management on their earnings call just says it all. We don't really have to grow volume to grow net interest income right now. What they're basically telling us is, hey, we did the hard part. The heavy lifting is over. Their business is now set up to grow its income almost on autopilot, without even needing to go out and write a bunch of new loans. So how is that even possible? Well, it's possible because of this built-in growth engine. They've got about $3 billion in old loans on their books that are about to mature over the next couple of years. Think of it like an old CD you bought when rates were super low. When it matures, you get to reinvest at today's much higher rates. That's exactly what's happening here. And you can already see it working. Their net interest margin at the end of September was already up to 3.76%. This is the secret sauce behind their confidence and why they're guiding for an even stronger Q4. All right, so they've ripped off the Band-Aid. It was painful, sure, but they've cleaned house and basically set a whole new, much higher floor for their profitability. But the big question for investors is, what does this mean for the stock from here? Well, here's our take at the next call. First things first, we need some context. Why do something so drastic? Well, look at this chart. The stock was getting hammered, down over 21% in a year, while the rest of the regional bank index was actually up. So this whole reset didn't just come out of nowhere. Management was under pressure, and they knew they had to do something big to change the story and get this stock moving in the right direction again. So looking ahead, it's really a prove-it story now. The new plan sounds fantastic on paper, but now it all comes down to execution. A few key things we'll be watching. First, can they actually hit that Q4 margin number they promised? Second, will that loan repricing engine kick in like they say it will? And finally, can they actually start growing the old-fashioned way by bringing in good, cheap deposits and making smart new loans? These are the real catalysts that will move the stock. So that brings us to our official call. For the next quarter's results, we're thinking they'll come in right around where everyone expects, maybe with a small beat. As for the stock itself, we see it kind of treading water for a bit, maybe drifting slightly up.
as the market takes a wait-and-see approach. And for that reason, we're giving it a market perform rating. Look, we think management absolutely made the right call here. It was a tough but necessary move. But investors are going to want to see a quarter or two of clean, solid proof before they really jump back in and reward the stock.
And as always, this is not financial advice.